Well, good day, all. Ira Epstein, and here we are with your morning flash update, and this is for Wednesday, the 6th of December, 2023, about 8:15 a.m. Central Time. You can see we're up in the markets right now, but I think you're in a congestion period. In other words, I think you've got to consolidate now. The gains that you made in November, it's going to be back and forth action. We have a lot of jobs report numbers coming out. We yesterday got JOLTS. This morning we got ADP. We're going to get Challenger Gray. Then we have the U.S. jobs report number coming out. We have productivity out this morning too. So maybe we go to those when we come back and we talk a little bit about what's going on. You started off with the mortgage market headline that you get weekly, and it's important. The index up 2.8%, but your eye should go right here, the refinancing. So as rates are slipping back, and they have come charging down, they're up 14% in the refi. Makes sense. ADP, private sector net change, 103,000. They expected 128. I don't put a lot of weight on ADP. It's the private sector. It's all over the board. It doesn't correlate often to what the jobs report on Friday is going to show. That report's estimated at 180,000 new jobs. 90 be normal. But the whisper number is 156,000. Remember, this will include people coming back to work from the UAW, that's the auto union strike. There were about 35,000 out on strike. The market thinks about 30,000 for that reporting period has gone back to work. When we come to the third quarter revised, non-farm productivity and unit labor costs, remember it's third quarter, we're already in December, coming to the end of the fourth, they saw that at up 5.2%, 0.3 greater than what they thought. It started at 4.7, so it gained a 0.5 percentage point. That's good. You're getting a lot more production out of the same people. The revised non-farm labor costs were down 1.2%. They expected it down 0.9, and the prelim was down 0.8. So that's where it's showing up. Same people doing the same job, producing more. The U.S. trade balance down $64.3 billion. They expected it down $64.1. And at 9:30, we get the all-important EIA stocks report. Last night, we saw the API numbers. We had a build in the products down about 500,000, 400,000 barrels. When you were taking a look at what we had in the oil stocks. And in the oil stocks, remember, we still have lots of problems there. The Biden administration says they're going to start buying oil. They lie all the time, so I'm not quite certain what that will do. But here you are. If they claim they're going to buy it, we should see news on it. You're down $1.60 right now, making new lows in January WTI. They had just said they were going to buy it under 72. I just read the reports. We'll see. I have no faith in them. I don't think they know what they do. I think it's the blind leading the blind there. It starts with the president, who has no eyesight in an energy policy, and who he hires are as blind as he is. And we're starting to get more of a bid on the grains. China has been doing a number of buys from the U.S. in the wheat market, which has caught the market by surprise. You're up to an area here where you got to be careful. This is about where I thought you'd come in the in Bitcoin. Prior, I was looking for $42,000 to $45,000 for the market as we were looking for when the SEC is going to allow the ETFs to trade based on spot. Haven't heard any word on it. Metal markets, a little bit of everywhere. That's the right way to say it. A mixed bag in the currency markets. So what I'm saying is that consolidation period. You had a phenomenal November. Now the market's waiting to see the next shoe. I write today about how the banks are already pricing in the market, the swaps market, pricing in for the central banks what they think. 1.5 cut for 2024 in the ECB, at least 1.5 for the U.S. 3 rate cuts of 75 basis points total for the UK. Will any of this come about? Well, it's predicated on two things. Number one, the market's slowing down, and we are seeing that in different parts. So we were running this way, and now the market is petering out like that, starting to come down, they're figuring, in the economy, and the central banks have to chase after it, pulling it back. It's much easier to tame inflation than deflation. It's much easier, if you will, when the market's going in a nosedive, it's not an easy thing to pull that airplane out of it. It's one thing to point it up and you can wobble it and come down. I used to do that when I was flying. Love to come down tail and then point the nose and have a ball with that. But try to pull it up out of a steep dive. It's not the easiest thing the faster your speed is going. And that's what you learn in the finance. Finance is the same thing. You want to keep the market from picking up that speed. So the central banks, to a tune, they will say they're going to be sticky. The market's going to say, no, you're not. And that's why you keep on all the brakes getting bids in the bonds and the notes, because they're saying the banks don't know what they're saying. They talk a game, but as the data comes in weaker, they know the banks will respond to that. And then they have to go into what their mandates are: full employment in the U.S., controlling inflation. So if inflation starts coming down, which it's been doing, we're in the sticky area. But if it keeps sliding through that, then they've got to look very hard at keeping employment as close to full as they can. That requires lowering interest rates. I'm giving you the simplicity of it, but it's right in front of you, and it's important you understand it. Now, you might want to take a look at some of the offerings we have. You know, if you go to our website under free offerings, there's about 11, 12 of these. I'm just showing you a few of them. You come into that page, you click what you'd want at the bottom of the page, you put in your email address, your name. We email you right away everything that you'd want. I solidly recommend, if you haven't got this, you want to get the daily QT price counts. They come out every day, and on the weekend we publish a whole digest of them for the coming week. I think they're so important. They're my guide as to where a market might go. The hardest thing is you get into a trend. Where might the market go? And this is a neat way of coming to that. It is not an entry point tool. It is an exit tool. And that is the